What's up everybody, Gen X Dividend Investor here. In this video I'm going to tell you about the new business opportunities that Realty Income is expanding into and why I'm bullish about their future. But before I go into that, I want to warn everyone about impersonators and scammers that are pretending to be me. Feel free to use the timestamps if you don't want to hear the warning, but I strongly urge you not to skip ahead. Okay, so basically I've been dealing with impersonators on social media, including on Twitter X, Instagram, and Discord. For example, yesterday a scammer on Discord pretended to be me and sent a message to people about joining a copy trading program that I'm supposedly running. It's a total scam and it's not me. I don't have any copy trading program, and if you watch my content then you'd probably know that I tell you not to copy the tickers I invest in, and I even did an entire video on why you shouldn't copy finance YouTubers or anyone at all. So if you're ever unsure whether you're actually talking to me, then just leave a new comment on any of my YouTube videos and I'll help you figure out what's going on. Don't reply to an existing comment thread since I don't always get notifications from replies. And for reference, my only X account is @GenXDividend, my only Instagram account is @GenXDividendInvestor, and my only Discord account is GenXDividendInvestor. Now Discord is kind of tricky because they have a display name, and I go by GenXDividendInvestor on YouTube, but any Discord account can use whatever display name they want, including the one I use. But one way you can tell it's me is if you click on my name, then you'll see the exact spelling of my username, which is listed underneath the display name, and I'm the only one on Discord with my exact spelling. Of course, scammers use names close to mine to try to fool you. Also, my name has a Gen X server tag by it, and I've not seen any scammers have it, and it's a link to my Dividend Discord. Scammers also don't have these 6 Discord achievement icons that you can see when you click on my name. My plan is to pick up more of those achievements if they roll them out, so it becomes even easier to tell me apart from the fake accounts. Anyway, now let's talk about one of my wife's favorite stocks, Realty Income, ticker O. Many of you know that Realty Income is a bit over 6% of my portfolio, and a few days ago they paid me my monthly dividend. So this is a screenshot I took on November 17th, and you can see that my Fidelity account is at $3.5 million worth of tickers. On the right hand side are the dividends I've gotten in the last couple of days, starting with my Realty Income ticker up top. So first in my IRA I got an O dividend for $788. The vast majority of my O I keep in retirement accounts due to how it's taxed, but I've also got a small position in my taxable. Next up in my IRA is a Colgate-Palmolive dividend that paid me $134, then an AbbVie dividend for $405, then an O dividend in my taxable for $34. Then you can see I did a $100 buy of IDVO in my IRA spread across 2 rows. Each month I take about 20% of the payouts for my dividend ETFs and reinvest them back into themselves. Well, I actually take $100 of my O dividend and use that to buy $100 of DEVO and $100 of IDVO, just due to the timing of how things play out, but it's effectively the same thing. Next is another Colgate-Palmolive dividend I got, but this one is in my taxable account for $212. Then another O dividend, but in my rollover, for $200. Then AbbVie in my taxable for $682. Then I did that $100 DEVO buy. Then another AbbVie dividend, but in my rollover for $441. Then my EPD position paid out in my taxable, and you can see how it's a return of capital for $2,607, which means I don't owe any taxes on it until my cost basis gets to 0, which will be years from now. Then I got a small Apple dividend for $60. Then you can see about $28 of fees for BTI as it's a British ADR stock, and I got a $25 dividend from it in my rollover, and $2,055 of it in my taxable. I also got $139 of it in my IRA, but that was on another screenshot. Anyway, in total I got about $1,023 of O dividends this month in November. If you'd like to see my entire portfolio in Fidelity, then watch a recent video I did called My Monthly Dividend Income, $12,619 a month. Okay, now let's talk about Realty Income, also known as the Monthly Dividend Company, which is a real estate investment trust that focuses on providing dependable monthly dividends to shareholders. It owns and manages a large, diversified real estate portfolio of over 15,000 single-tenant commercial properties, primarily retail and industrial, that are leased to more than 1,600 clients in industries such as retail, manufacturing, and many more. Its primary business model is to acquire and manage properties under long-term net lease agreements where tenants are responsible for most property expenses like taxes, maintenance, and insurance. And these are their top 20 clients right now. 7-Eleven is 3.3% of their rent. Dollar General is 3.2%, and you'd probably recognize most of the names, including Walgreens, Family Dollar, Wynn Resorts, FedEx, Bellagio, LA Fitness, Home Depot, AMC Theaters, and Walmart. Now you might be wondering why companies like Walmart or Home Depot rent from Realty Income. I mean, they're clearly strong enough financially to own, so why rent? Well, they rent many of their stores because it makes more financial sense to do that than tying up billions of dollars in real estate. And by leasing from companies like Realty Income, they can use their cash to grow their business instead of locking it into land and buildings. Plus, triple net leases shift most property costs to the tenant, so renting ends up feeling similar to owning, but with more flexibility and less risk. I appreciate how Realty Income has thousands of customers across different industries because that reduces the risk to them if one industry goes down the tube. So about 10% of their rent comes from grocery stores, another 10% from convenience stores, 6% from home improvement, 6% from dollar stores, 5% from restaurants, 4.5% from health and fitness, and so on. One big reason why I'm bullish on their growth is because they're expanding internationally, which opens up a ton of options. Plus, they've got a great track record of being able to expand, and there's a ton of the world they can grow into. Another thing I'm bullish on is O's portfolio occupancy, which has never fallen below about 96% in their multi-decade history. That means almost all of the properties Realty Income owns are rented and producing income for them and for me. That's pretty amazing because it means that through the pandemic, the great banking financial crisis, and the dot-com crash, Realty Income had strong enough clients who persisted and kept paying them rent. Plus, they've been paying and increasing their dividends for over 30 years, which is longer than I've been married, and I expect them to keep doing that as well, even though nothing is guaranteed when it comes to investing. However, it's not all roses for Realty Income, and some people are understandably frustrated by O's stock performance over the last few years because it never really bounced back after the pandemic. Like, check out this crappy 5-year return history for them from Seeking Alpha. O's only done 20%, as compared to 99% for the SP 500. But it was doing fine until around when the pandemic hit and interest rates went berserk. And if we go back to when O went public in 1994, then we see a completely different story. Now we see that O's total return is at 3,470%, which is almost double the SP 500 at 1842% over that time frame. We know that the market has returned about a 10% annualized return over time, which is materially less than the 13.5% that O's returned. And Realty Income has increased their dividend by 4.2% per year, on average, over the last 3 decades. So bottom line, like most investments, when you buy matters, and I'm not stressing over the rough stretch it's been going through. I'm not selling, so I just take the passive income and wait for things to recover. It's kind of like collecting rent checks. I mean, the buildings might not be shooting up in value right now, but they're still paying me, and over the long run I expect the value to come back. I don't worry when I see a good asset underperforming, because I know the market misprices things all the time. Like, I also didn't freak out when Microsoft's stock price was effectively negative from 1999 until 2014. That's 15 years, people. Now, I'm not saying Realty Income is the same as Microsoft, but in its lane, it's been an incredible investment for people who stayed the course over the long run. Of course, what really matters is where it goes from here, and one challenge O has is that it's gotten pretty large, which naturally makes growth a bit harder. But I still think the growth will come. And its stock underperformance over the last few years is actually part of why it looks underpriced to me right now, which is one of the reasons I'm bullish on it. For example, this fast graphs chart shows me that Realty Income looks cheap. The black line is its stock price, and you can see it's under the market fair value price in orange, and way under the blue line, which is how the market has historically valued it. Now, I'm not buying more shares right now because I'm living on my dividend income and only reinvest a small amount back into the ETFs I want to grow. But if I was buying individual tickers, O is one I'd personally go into. I'm not recommending you buy more, I'm just saying what I'd do. Anyway, another interesting way I like to get a sense of whether something is cheap or expensive is to look at its dividend yield trend over time, kind of like the dividend queen herself, Geraldine Weiss. Here you can visually tell that O's dividend yield right now is almost 6%, and that's higher than its historical average. The higher the yield, that generally means the lower the stock price, so that's another indicator that it might be a bit cheap right now. Though as always, you never know what the future might bring. O could crash, go sideways, bankrupt, shoot up, whatever. And if inflation starts going up again, that'll probably make things tougher for REITs like Realty Income. You see, when inflation climbs, interest rates usually rise too. Higher rates make it more expensive for Realty Income to borrow money for new properties, and the rent they collect doesn't always increase fast enough to keep up. And because of that, investors start viewing their future earnings as less valuable, which can push the stock lower. Or if the broader economy slumps, we'll likely see O drop for a while too, even if some factors still look positive for it. Anyway, I love the fact that I get real estate exposure as part of my investments without having to deal with tenants, maintenance, or any of that stuff. I don't have to do anything and I just get paid each month, and I expect that long after I'm 6 feet under, my wife and kids will keep getting paid as well. And once my kids grow up and get married, I bet my grandkids will also get divvy checks for my own investments, and hopefully their kids too, for many generations to come. Speaking of dealing with tenants, check out this brief clip of a real estate investor dealing with one of his tenants who can't cover his rent for the month.
Hey, Steve?
Hello? Yes?
So I came to pick up the rent. I'm at the mailbox now, and there's only $420 in here.
Well, I'm a little short. I had other expenses. I missed some work.
Come on, dude. The rent's $2,000 a month. You're $1,600 short. That's unacceptable.
Hey, well, in the past, I've always been on time. I'm having a little problem this month.
I mean, that doesn't help me at all. I have bills to pay. I got to pay the mortgage on the house, the taxes, the insurance. So, I mean, when are you going to have the rent?
I just don't have it. There's no money in the bank. What do you want me to do?
That clip reminds me of my dad, who used to complain nonstop about real estate investments. He was constantly losing sleep over a tenant not paying, or something sitting vacant, or even random things like an adjacent property having underground environmental leak issues that ended up on his property. There was always something pissing him off, whether it was a local government person he was fighting with over zoning issues, or with the more common problem of tenants being late with rent. So I got a lot of hands-on experience with his and our relatives' investments, and because of all that I can understand why people love it and why people hate it. People often love it because you can make great money and you get awesome tax benefits, but you can also hate it because it takes time, it's stressful, and it's nowhere near as easy or liquid as stocks. I love how my dividend portfolio just keeps the cash coming in, and it gives me peace of mind knowing my family will benefit from the investments I made long ago, even with them knowing nothing about stocks. They won't need to spend their time and energy and stress learning it, managing it, and dealing with it. Now, that doesn't mean they should stay ignorant to stocks, because even blue-chip dividend portfolios can benefit from some hands-on guidance, but it's still a lot easier and faster than physical real estate. And sure, outsourcing management to property managers helps a bit, but you still end up dealing with the big stuff and all that stress I don't want to deal with. And again, that also reminds me of my dad, who's always had a nasty temper, and he's been super frugal. He once gave us an angry speech about how us kids use too much toilet paper, and that it was called 2-ply for a reason. I'll leave the rest to your imagination. He yelled at us if we took a shower and left the water running while we soaped up, and he expected us to leave the water off for about 90% of the shower. And if we ever left lights on the house and we weren't in a room, it'd be World War III. Now, to be fair, my dad's dad died when he was just a kid, and he was raised very poor, so he and his brothers all started working when they were literally like 5 years old. My dad is almost 90 these days, so yeah, he goes way back. He's always had a strong work ethic, and he's mostly been penny-wise and pound-wise. He only got into stocks once, but pulled out before he got anywhere. I could make a joke about that, but I won't. Anyway, my dad's the type of person who'd never go to a Starbucks, but if he was forced to, he would order a black coffee and an extra cup, and pour half of his into the spare cup for whoever he was with just to cut down the price. But my dad was also the person who taught me how important it was to save. He was the guy who took me to Wells Fargo when I was just a kid and opened my first checking account. He taught me about interest, and he always stressed about living within your means and putting part of your money away for the future. I tell you all that because his personality was part of what turned me off to real estate, so I'm kind of biased against it. At least physical real estate. But I still recommend everyone at least consider investing in physical real estate because you can make a ton of money with it, and some people absolutely love it. Like this story just came across my feed about a guy who worked in law for years, then decided to quit and invest in a mobile home park, and now he does that full time and is happier. Of course, a more common way to get into real estate investing is by buying single-family homes or condos and then renting those out. Anyway, another reason I'm bullish on O is because they've started a new business where they manage money for other investors, not just invest their own. So instead of only buying properties with their balance sheet, they now have a private capital fund that outside investors can put money into. Realty Income then chooses and manages the properties in that fund, and that lets O earn management fees and possibly performance-based rewards. I see this being good for three main reasons. Number one, it gives them a new source of profit. Basically, fee income from managing outside capital can add steady revenue that isn't tied to property rents. And fee income from managing outside capital often has higher margins and is less cyclical than just owning operating properties. Plus, this allows for a diversification of revenue, which de-risks things a bit. And tied to that de-risking is the fact that it might reduce the pressure to chase high-yield deals for their real estate portfolio. You see, the market always wants to see growth, and that can sometimes push management into doing weaker deals just to hit the street's expectations, but bringing in this new income may help temper that risk. Another thing to realize is that same-store growth has been pretty weak for O, so having new lines of business can offset lack of strong growth in its core net lease portfolio. Overall, I think this additional business shows that management will drive towards growth even when the overall market may be stagnating, and growth might be the number two reason why they're doing this. I mean, their usual way of growing is by buying more properties to rent out, but that gets harder when interest rates are high or when good deals are harder to find. So managing outside money lets them keep growing even when their balance sheet or the market is limited. And number three, they're using some of the skills that they have and are trying something new. The fact is that Realty Income has lots of experience in finding and managing net lease properties, and this new business opportunity allows them to leverage much of the in-house skills they have and earn extra and more money by doing it for others. Bottom line, this should allow them to earn new fees and grow without taking on too much debt, all of which should increase returns for shareholders like me. But running a fund for outside investors still has some new skill sets needed to succeed, even with their experience. So if the fund does poorly or costs rise too much, it might not add in the income they hope, not to mention it also makes the company more complex, which itself is a risk. Hopefully they don't need to divert too much attention and resources from their core business into this new opportunity. And I believe fund management businesses can have higher costs due to raising capital, marketing, and compliance, and the margin may take time to scale. So if O's management is wrong and the returns are lower than expected, then that could lead to reputational risk as fund investors get disappointed. That all being said, overall I think this is a good move because it signals that Realty Income is looking to future growth beyond the steady but modest growth of their core net lease business. But the magnitude of benefit will depend largely on execution, i.e. how well Realty Income can raise third-party capital, generate returns above its cost of capital, and integrate the new business without distracting from its core business. It'll be interesting to see how quickly the private fund business grows, and I'll be looking at their trends of assets under management, their fee income, and their overall returns as time goes on. It'll also be interesting to see how the returns and expenses from that business compare to Realty Income's own portfolio returns. But there's actually more than that I'm bullish on. For example, the bad debt expense in O's portfolio has historically been very low at only about 0.4% since 2014. That speaks very highly to the company's stability and reliability as a landlord. Bad debt basically tells you how much money a company fails to collect from customers who owe it money. So that means from 2014 until now, O's only lost, on average, about 0.4% of its annualized base rent. Like out of every $100 of rent income they plan to collect, on average, they only lost about 40 cents of it to clients who couldn't pay. Thus, their tenants have been of high quality, as they've basically not been defaulting or going bankrupt or whatever. And again, great results in the past isn't a guarantee for future performance. But it does show me that their management team has built a portfolio of properties and tenants that are highly dependable, and all that has led to a reliable income stream for us shareholders with very few instances of tenants failing to meet their lease obligations. Another bullish sign for me was that in Q3, they invested $1.4 billion at an initial weighted cash yield of 7.7%, including Europe at about 8%. That means for every $100 they invested in properties, they expect to collect about $7.70 in rent in the very first year. And because they often borrow or raise capital at lower rates, the spread between cost and yield looks attractive. Plus, Europe yielding around 8% means those deals are paying even more than the overall average, which boosts total income. So bottom line, they bought properties that pay them a strong cash return from day one, which supports higher earnings and dividend stability. I'm also bullish as it says they sourced $97 billion of volume year to date, surpassing previous annual sourcing records. That's a good sign for the company because it shows that they have an unprecedented amount of choices when deciding what to buy, which allows them to be very selective and only invest in the highest quality deals. Beyond that, I'm also bullish about their debt situation. For example, they said they finished the quarter with net debt to annualized pro forma adjusted EBITDA of 5.4 times and a fixed charge coverage of 4.6 times. Or to put that in layman's terms, it's kind of like saying they're a responsible homeowner. Their debt-to-income ratio at 5.4 is very healthy, meaning their mortgage is easily affordable given their steady paychecks, which in their case are the rents. It means their paycheck is 4.6 times larger than the amount needed to cover their required payments, giving them a massive emergency cushion and total peace of mind. It's kind of like having a monthly mortgage of $2,500 while bringing in income of about $11,500 each month. That means you've got far more income than you need to cover your payment, so day-to-day finances stay comfortable and stress-free. And that's basically what their fixed charge coverage shows, plenty of room between what they owe and what they earn. Their overall debt level lines up with that picture, meaning they're borrowing in a way that keeps things stable rather than stretched. So their debt supports growth while keeping plenty of protection against any slowdowns in rent that might happen. And another thing that makes me bullish is their strong credit ratings, especially if things go south. This shows that they have A3 and A- credit ratings. That's like getting an A or A- grade on your financial report card. It tells banks and investors that Realty Income has a strong capacity to meet its financial obligations and that the risk of default is very low. And you want to see that because higher credit ratings means lower borrowing costs, easier access to capital, and a lower risk profile. That makes them appear as a safe borrower, all of which should help them grow more cheaply and steadily. Another reason I'm bullish is because they provided AFFO per share guidance of $4.25 to $4.27 for 2025. That range is a good signal because it shows the company expects solid and steady cash flow for the year. AFFO per share tells you how much real cash the business produces to support its dividend, and staying in the mid-420s means that cash flow remains healthy. So it tells me that their dividend is well covered and their cash generation remains strong. But their weak same-store rent growth at 1% isn't exactly hot, though that fits the nature of net lease REITs like Realty Income, where long-term leases only have small built-in rent increases each year. That means tenants rather than the landlord kind of absorb inflation and rising operating costs, which helps keep Realty Income's cash flow steady even when costs go up. The trade-off is that organic growth stays limited, so most increases in AFFO and the dividend need to come from new acquisitions rather than rising rents. This means 1% growth isn't a problem necessarily, but it does place a ceiling on how much the existing portfolio can grow on its own. And given inflation and cost pressures, a 1% growth rate can weigh down on their potential. Anyway, I could go on and on about pros, cons, risks, and issues, but hopefully you get a flavor for things. Overall, I feel that Realty Income appears well positioned as a large, diversified net lease REIT with a strong credit and dividend track record, which makes it appealing for income-oriented investors seeking stability. It has decent growth options from international expansion, private capital initiatives, and a strong acquisition pipeline. However, investors should temper expectations around growth as same-store rent growth is modest, acquisition yields may be squeezed, and macro risks like interest rates, tenant credit, and valuation pressures remain real. Bottom line, to me it seems like O is a solid investment for stability and income, but it's less compelling for outsized growth, though who knows what will happen. Please leave me a comment and tell me if you own any Realty Income or not, and if you feel their future looks brighter than the last few years. Also, please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out my latest Patreon King who just signed up, so thank you Mario Duran Meza. Kings get everything my lower tier Patreons get, plus they get to chat with me voice over my Discord for 30 minutes about whatever they want, though remember I'm not a professional financial advisor. I'd also like to pitch that Seeking Alpha, which I'm an affiliate of, is running a Black Friday special deal from now until December 10th, 2025. Their premium subscriptions are $60 cheaper, their alpha picks are $100 off, and they have some other great discounts. Check out my link in the description below if you'd like to sign up. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Jay Vasquez, With Twos You Lose, Marco Opdeweeg, Apezu Kola Booster, Mark Shio Prasad, and then multiple from Josh Mallet, multiple from Keithman 5000, multiple from Canuck Dividends, multiple from Tomi Partika, and multiple from Mr. Ted Persinger. Thanks folks, I really appreciate it. Now I'll close things off by pitching my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.